I did. Good afternoon. I do apologise. We've had technical issues yet again, a little bit late today, but welcome to BizTech Asia's Midday Market Watch, which is actually going out at 7 minutes past midday. Today, our guest is Tim Water, Chief Market Analyst at KCM Trading down in Australia. Tim, welcome to the program.
Hi, Jeff. Thanks for inviting me on. Good to be here.
Before we speak to Tim, let's have a look at the performance of Asian markets around the region. And it's been an interesting day as most of the region returns from the Lunar New Year holidays. The Nikkei 225 is up 2.66%, led by SoftBank after ARM Holdings' share price rocketed by nearly 30% overnight. Shanghai and the Hang Seng are closed today. Mainland China and Hong Kong are still on holiday. Down in Australia, the ASX 200 is up down 0.16%, while South Korea's Kospi has also got a bit of a tech tailwind, up 1.03%. In Singapore, the STI has fallen 0.62%, but in Kuala Lumpur, the KLCI is up 0.99%. Tim, what do you make of today's market movements? It very much seems to be driven by this ARM's holding release last night, even as US markets themselves had a bit of a pre-CPI jitter.
Yeah, well, that's right. Looking across the Asian markets today, obviously Nikkei is having a bumper session. Kospi is doing quite well also. If we look at the Nikkei, as you mentioned, it's really tech driven. And I think there's a parallel there to what's been going on in the US so far this year, where it is really coming down to that tech sector, chip makers, AI environment to drive the market. So I'm not sure whether that's a good thing or a bad thing. Longer term, maybe we need to see some other sectors of the global economy coming to the fore, and not just the tech aspect of it. But let's see. But for the time being, yeah, good performance from the Nikkei. A little bit more muted down here in Australia today. Fairly flat to mildly negative performance on the ASX. A number of reasons for that. We've had some of our big companies reporting corporate earnings so far today. So CSL, they came out with a profit report pretty much in line with expectations, but they're still feeling the effects of the news of that failed clinical drug trial yesterday. That's dragged the stock lower. Elsewhere, we had the cement maker, James Hardie. Once again, pretty good headline number there today, but the stock is down, really based around the uncertain outlook they've provided. So reading between the lines, it looks like there's some concern about the global housing market moving forward, or at the very least some uncertainty. And James Hardie says as much today, and the stock price reacted accordingly by heading south. The other one we had locally here was Macquarie Bank. They released their trading update, which didn't make for very pleasant reading. They said their profit looks like it'll be substantially down, and so was the stock price today. So I think those three stocks certainly weighing on the ASX, and that's why we're having a bit of an ordinary day at the moment.
Well, let's contrast that with US earnings and strip out the Magnificent Seven, which have, of course, driven so much of the price gains in US markets this year. Australia is very much, if you could call it, a real economy sort of market. How are earnings comparing in Australia, per se, compared to, say, the real economy sorts of companies in the US during this earnings season? Are those companies in the US also having challenges, or is this more Australia-centric?
I think if you look at some of the US real economy, there are some challenges. We'll get a little bit more of an indication as the earnings season rolls on. So yes, certainly there are aspects of the economy struggling more than that tech sector. It is a similar story here in Australia. I would say we're slightly underperforming where the US is at the moment. And I think that's largely because we're feeling the effects more from that sluggish Chinese economy. Our export market really hasn't kicked into gear because China, since the reopening in 2023, has really been in a stagnant state of economic growth. And so that's acting as a constraint on our export market at the moment. And the other is, which you alluded to, is, while we do have a very much, I guess, a burgeoning tech sector here, it is certainly in an infant stage compared to Silicon Valley. So we're not getting those same tailwinds from the tech sector. But yeah, to answer your question, I think that if and when we did see Chinese economic activity pick up, the question is, I guess not so much if it will occur, but when, then I think we could start to see the Australian economy starting to make up some ground versus the US economy.
It's often forgotten, but quite important for our viewers to know that something like 80% of the US GDP is actually derived from domestic consumption, whereas, of course, that number is slightly different for Australia.
Absolutely, yeah. We are much more reliant on that export, related growth.
Tim, let's turn our attention now to this week's data highlight globally, and that will be the US CPI released tonight. Closely followed word for word, digit for digit by Fed watchers everywhere for quite obvious reasons. US markets caught a dose of pre-CPI jitters overnight before the market closed. What are your thoughts about the data that's going to come out today and its potential impact on the market?
Yeah, the number tonight, CPI for January, could be a pivot point for the market. As we know, investors and the financial markets in general, very much interest rate sensitive, hanging on every word of a Fed speaker, hanging on every, major economic data release, such as non-farm payrolls a couple of weeks ago, and obviously the inflation figures, and we get the latest read on that tonight. We have seen, the gap close so far this year between market expectations for US interest rates, which is looking at maybe around 5 cuts versus what the Fed themselves expect, which is probably around 3 cuts this year. So used to be a chasm. It's closed more to a gap at the moment because on the back of that solid data we've had from the US. If we did see a figure on the hotter side of expectations tonight, maybe a 0.3% reading for that CPI figure month on month, I think that could push out the hopes for perhaps a May hike back to the second half of the year, which could have a negative impact on risk assets and see some of your safe havens come into play. And the US dollar perhaps move higher. But conversely, look, if we saw a 0.1%, 0.2% figure tonight, a bit of softness in the core, that could keep a May hike
very much alive.
A May cut could be very much alive. So yeah, it just comes down to that data tonight. But as you say, I think the market will be certainly watching that figure very closely, and we'll see what happens. But right now there is still that gap between the market and the Fed. We could either see that widen or narrow, depending on what the figure comes out at tonight.
Very much so. Let's stay with inflation risks for now and turn our attention to oil prices. They remain elevated. We all know about the geopolitical risks running around in the world and their potential impact on oil prices. What are your thoughts on the direction of oil prices from here? And I'm also interested to hear what you think about the potential inflationary upside risks to oil prices if that geopolitical situation deteriorated.
Well, that's right. Yeah, I think if we look at, say, the WTI contract and Brent at the moment, I think they're priced about right now. Going back 6 weeks ago, I would say they were underpriced. There wasn't enough risk premium built in, given that conflict that does seem to have been escalating, albeit incrementally in the Middle East at the moment in terms of growing US involvement. And of course, we've seen that what's happening in the Red Sea, shipping containers being rerouted. So those supply concerns have come to the fore more, and that is being impacted and reflected in that oil price at the moment. So I'm not surprised to see where it is now, but given that we haven't seen a lowering of tensions yet, I think there is scope for oil to move higher in coming months, and perhaps pushing more towards that $80 a barrel level and higher. And if we did see that, of course, that would play into the global inflation picture, in terms of logistics, supply chains, and the like. So I think this oil price, certainly one we're watching very closely, because it can have an impact on the global inflation picture and in turn interest rates. So that oil price, it's been creeping higher, and it certainly has the potential to maybe upset the apple cart in terms of when we may start seeing that monetary policy easing from central banks around the globe. So definitely one to watch out for is the oil price at the moment.
Speaking about inflation still, let's turn our attention to the world's oldest inflation hedge, gold. Prices still remain above $2,000 an ounce, and gold prices can be a savage mistress, and there's plenty of bullish traders who've been caught long and wrong at the top of rallies. Do you think that gold prices can continue to hold above 2,000, or is it other extraneous factors that will decide its fate?
Yeah, I think like longer term, so looking for the second half of 2024, I think there's a bullish case to be made for gold, given if it can hold onto that 2K level at the moment, where US interest rates currently are at the moment, you can make a case that once the Fed does start cutting, that'll take a toll on the US dollar. Bond yields may come off the boil a bit, and that could open the pathway higher for gold to sort of trade in that $2,050 to maybe $2,100 range in the second half of the year. More shorter term, I think it's a bit more choppy price action we're likely to see. That's why we're seeing gold sort of lingering closer to 2K rather than going up to 21K at the moment. And it is because of that repricing of the interest rate picture on the back of the Fed speak, Jerome Powell, non-farm payrolls. So that's keeping the US dollar elevated. DXY is around 104 at the moment, a little bit higher, which makes gold more expensive to buy for foreign investors. And bond yields in the US still above that key 4% level on the 10-year note. So those bonds are providing, I guess, a very much a viable alternative as an investment to gold at the moment, which is a non-yielding asset. So they're the main reasons why gold's struggling a little bit at the moment. And I do think those struggles could continue in the short term, particularly if we've got, say, a hotter CPI print tonight. I think that would hurt gold. But I think longer term, I think there is a case to be made that gold could move higher, but that's very much reliant on the US dollar, taking a leg lower at some stage.
Wonderful. Tim, thanks so much for your insights today. It's been a pleasure having you on the show.
My pleasure. Jeff, thanks very much for having me on.
You've been watching BizTech Asia's Midday Market Watch. I'm Jeffery Halley. Once again, apologies for the technical issues that we had again today. This video and podcast will be on our website, www.biztech.asia, our social media platforms, as well as with our syndication partners, TV stations, radio stations, and websites. Thanks so much for tuning in.